looking at our overall footprint, that's the driver for us reducing our Scope 1 emissions.
Dave, Fortis listed on the New York Stock Exchange in 2016 following an acquisitive period in the company's history. For those who don't know about Fortis, give us a quick history lesson about your roots and your regulated utility growth story.
Certainly. So we started out as a very small utility company in Newfoundland. It was Newfoundland Light and Power way back in the day. Currently it's Newfoundland Power. So we looked in 1987 at how we can grow. Obviously being in a small province, technically on an island, we needed to grow through acquisition. So we created a holding company, Fortis, and its first wholly owned subsidiary was Newfoundland Power, and we looked at growing through acquisitions. So the very first acquisition we did was Maritime Electric in 1990, so it didn't take us long to figure out how to do the acquisitions. And then after that, we did some acquisitions in Ontario, the Caribbean, some smaller utilities, but they add up over time. And then we took some big bets and went all the way west into BC and Alberta, and we bought electric assets and natural gas assets out there, and that was in 2004 and 2007. So we're starting to get a pretty decent size at that time, but kind of running out of investment opportunities in Canada, so wanted to start looking at what in Canada we call south of the border, which is the United States. And in 2013, we made our first acquisition there, which was Central Hudson, which is in upstate New York. And then in 2014, we acquired UNS Energy, which is where I joined the group. I was president and CEO at the time of that acquisition. And then the last acquisition that we made was in 2016, and that was ITC, which is a big transmission company with a footprint across multiple states in the Midwest. That was a big transaction, almost 12 billion US. And that's when we listed on the New York Stock Exchange, because it was such a big transaction. We wanted to make sure those shareholders could also, keep their investments in Fortis in the U.S. So as we stopped there in 2016, we stopped and kind of evaluated where we were as a company. And we said, you know what, this is the right time to pivot to an organic growth story, because one, we're big enough. We were definitely big enough. We were diverse enough because we had assets basically across the entire footprint of North America and the Caribbean. And we had the ability to grow from an organic perspective because of those jurisdictions that we now owned. And I can tell you the best is seeing the proof. And when we just put out our 5-year capital plan back in September, for the next 5 years, we're going to spend $26 billion Canadian over the next 5 years investing in the infrastructure and all those utilities. So we got 10 utilities. We're across 5 different Canadian provinces. We got a footprint in 10 different US states and 3 Caribbean countries. So plenty big, plenty spread out, and got the organic growth model to be able to make us successful going forward.
Now, as a large North American transmission and distribution company with an ambitious net zero target by 2050, tell me about your resource transition plan.
Probably the main part of that question is we're mostly a T&D company. So transmission and distribution assets make up 93% of our asset base. So only 7% is generation. 2% of that is, hydro or renewables. So we're really focused on that 5% of our assets that are fossil generation. And almost all of those are in Arizona, where I used to be the president and CEO, so I'm very familiar with those. So years ago, we were doing a resource transition plan to figure out how to not just diversify our portfolio away from some of the coal that we had in that portfolio, but also look at really having the growth opportunities from a clean energy perspective, and obviously do what we can to support the clean energy goals across our states and across our country and the Canadian country. We wanted to make sure we're aligned with those goals. All of that transition is very well laid out in an integrated resource plan that we just got done discussing with our Corporation Commission in Arizona, that laid out how we were going to transition those coal generators to renewables, battery storage, and a little bit of natural gas. And looking at our overall footprint, that's the driver for us reducing our Scope 1 emissions. So we've got an aggressive goal to be 50% lower in emissions in 2030. This is all compared to 2019. We have a 75% reduction by 2035. and then a net zero goal in 2050. And since 2019, just through last year, through 2023, we've already reduced those emissions 33%. And frankly, we know how to get to that, right? That other 75% reduction. It's shutting down the coal plants, putting in renewables, battery storage, and a little natural gas. So we can get there. We have a very good view. It's not only a pragmatic approach, knowing that we can do it, but we can actually show you what we have to do in order to do it. Now, once you get past that 75%, you get to net zero, there's got to be some new technologies and some new things, because we'll have some natural gas that we either have to figure out how to do carbon capture and storage, or look at burning hydrogen in those plants. So we've got a good story, and we're definitely executing on it.
Now let's talk about your dividend record and your outlook going forward.
This all goes back to, let me talk a little bit about our capital plan. I mentioned that $26 billion 5-year capital plan, and that gives us 6.5% rate base growth, which is kind of the engine that produces the earnings for a regulated utility. And when you see that level of growth, you can support the dividend growth that we have put out there. So we put out a dividend growth guidance for the next 5 years of 4 to 6%. And so we just in September of this year declared a fourth quarter dividend that was a 4.2% increase, and that was the 51st consecutive year of us increase in dividends paid to our shareholders. So 51. So that's rare air. There's one other Canadian company who has hit that 50-year milestone. So we're one of two in all of Canada that have done that. And again, when you look at us going forward, that rate base and that growth plan, we are very comfortable with that 4 to 6% dividend growth rate over the next 5 years. So we're not done yet. We're not done yet. We're still working on that. And a lot of folks, always wonder, it's like, well, why are you focused on the dividend? I mean, we're focused on total shareholder return, right? Like everybody else. There's different pieces, but you have to understand your shareholder base. And our shareholder base is about a third of them are retail shareholders. So that third, wants that dividend and is focused on that dividend. So that's very important for us and for our shareholders, that we keep up that track record.
All right. Well, Dave, it's been wonderful to talk with you. Thanks for joining me on Floor Talk today.
Yeah, thank you.